Hey everyone, my name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. And let's dive in and see what people are sharing today. You can follow me on here at finding_finance, and you can join our community, finding-value.com, where I dive deeper into individual companies, individual sectors, and share my opinions open and freely about individual companies. So, JC Parrots, is the bet that the blue line keeps falling the black line, or do we have a better idea? So bonds basically follow the dollar. And when the dollar strengthens, which is the denominator here, the Japanese yen loses value. And we just have a breakout basically occurring in the Japanese yen going down, which means the dollar is breaking out to the upside. And when the dollar breaks up, bond prices break lower. So people are selling our bonds, interest rates are going up, and the dollar gets stronger in relationship to other currencies. That's been the correlation, at least recently. And he's saying, with the breakout in the Japanese yen, that also could mean that we get a breakdown in bond prices. Yep. Tavi says, I like Brazil for other reasons. It's a resource rich economy with one of the most undervalued equity markets in the world today. Also, relative to its own valuation history, in what I believe to be the beginning of a commodity cycle. Keep in mind, I've never seen a secular bull market in gold that didn't unleash a similar trend in other natural resources, particularly commodity led economies. At current depressed valuations, the scenario I'm suggesting remains incredibly mispriced and, in my view, is yet another opportunity. So he likes Brazil. One thing I will say, though, and I put this here on purpose next to the dollar, if the dollar continues to go up, where yields go up, dollar goes up, and yen goes down, and all the other currencies that the dollar is compared against go down, we could see Brazilian equities go sideways and stay cheap. Last time we saw Brazilian equities go ballistic is when the dollar fell against other currencies. I do think that's potentially out in the future, but when looking at interest rates here in the short term, I do see a lot of strength in the dollar, DXY, particularly against other currencies. And I do see strength in interest rates going up, not down. So this might be delayed of what he's talking about for emerging markets and other uh, economies out there, where when their currency goes up against the dollar or our currency, that is when they take off. And I think it might be delayed for some period of time. The market was setting this up to go up because of the rate cuts. And the rate cuts we were gonna get a weaker dollar, in my opinion. But now that CPI is on the hotter side, we could see interest rates and the dollar go up, which will impact those equities. So charts on US petroleum inventories in million of barrels. Look at this here, guys. So here's crude, commercial, and SPR. That's way down there compared to other areas going all the way back to 2015, all those years. We are the lowest we've been. And during some of those years, oil was higher than where we are today. We were in the $100 a barrel range for some of 20, is that 2014 or 15? I can't, oh, maybe it was before that. Maybe it was 13, 2012 and 13. Anyway, we are below inventory wise commercial and SPR inventories. Distillate and kerosene jet fuel, we are on the lower end. We're not really that high, and we'll see what this summer has in store for us here. We've got gasoline here, which is on the low end, the lower side of inventory, and then total inventories of all of these. You can see that we're at the lowest level that we've have been since 2015. So our inventories are draining a little bit. That's definitely the case. And we continue to show good demand and relatively weaker supply in relationship to the demand that we have. So we're eating through inventories. We are running deficits, boys, running deficits. The Kobe oscillator, I like this one. The current situation that we're in, bonds are trading like rate hikes are coming. Gold is trading like rate cuts are coming. Stocks are trading like the soft landing is gone. Oil prices are trading like the Fed avoided a recession. And housing prices are rising like interest rates are at 3%. Nothing adds up here. And I think that's what's going on is everyone's looking at this from the old paradigm. They're not looking at it from the new paradigm that inflation is just overpowering everything. And a lot of these relationships are starting to break down because of that inflation. So nominally, it's hiding things. Prices are going up. And, I saw an article or a statement from an article that said the economy is stronger than what it is. And I'm sitting there like, they interchanged the economy and inflation kind of interchangeably. But what if you're understating your inflation to overstate your GDP? What if GDP isn't as strong and they're just printing the money to hide everything on a nominal perspective? I think that's what the case is. I think that's what the case is, guys. They're just printing money and just hiding crap. Citadel's head of commodities, Barak, we're on track to have an extremely tight global oil market. OPEC has definitely regained control. That's what all those inventory numbers that we saw above. That's what it's pointing to is a tight global oil market. We're running deficits and eating through inventories. Coming down to game of trades, he says gold is now breaking out to new highs. History shows that this is a major warning signal. And I'm just looking at this chart breaking to new highs, and I'm like, man, that looks good. Um, so I'm not going to go necessarily into this thread, but this looks fantastic for gold. And well, you know what? Let's click. Screw it. It says on 1st October 2007, gold broke out to all-time highs for the first time in 1.5 years. Thereon, the U.S. unemployment rate began rising rapidly and the economy growth slowed down, which ended in the 2008 financial crisis. But yes, gold is sniffing out potential lowering of rates, but inflation isn't slowing down. The surge in gold in 72 and 78 preceded destructive waves of inflation. Here's the problem with this, though, guys. This was a housing market crash, and a housing market crash. All three of those ended in housing market crashes. I don't think we're in a housing market crash. Gold is once again breaking to new all-time highs. Agreed. But correlation isn't causation. So I think he's wrong that what the driver necessarily is. The driver isn't the real estate market, but it could be something else like technology stocks that forces the Fed. Well, it doesn't force them. It influences the Fed to lower rates to save a presidential election, perhaps. I'll say it that way. That's what they're trying to do. This guy says, in quote, buying a home is for suckers. Renting saves time, money, and lessens brain damage. My garbage disposal breaks. Call the property manager. They'll pay for a new one and install it. I haven't thought once about saving for a new roof. The owner certainly has. Renting at the right spots gets you a gym, a pool, a park, etc., without spending hardly any extra. I don't see any need to buy a home until my kids are teenagers. Even then, the only reason I'd be considering buying then is because I'd want to have my own land and farm. Am I an idiot for thinking this? Well, I think it's really short sighted, is what I'll say. Because I purchased a while back knowing that we were going to get inflation. That was my opinion. And the way I thought we were going to get inflation is from the real estate cycle. So I purchased knowing that the house prices were going to go up. I wanted to lock in my costs because of inflation. And my costs right now are about one third the cost to rent, maybe slightly more than a third of my total costs. That's insurance, that is my mortgage, property taxes. And I just got a new roof on my house, but insurance covered it because of hail damage. So I'm not really saving for a new roof. Now, you're paying for all of that stuff in your rent. So rent is paying that. It might just be distributed amongst more people if you're living next to a bunch of other people. But I can tell you this, if I overnight made you a billionaire and you were living in an apartment, I guarantee the majority of people who live in apartments, if they were given $1 billion, would go out and the first thing that they would do, or the second thing, or something very close to the first thing that they would do, would be to buy a house. One that they really liked and one that they wanted in a certain location, and one that is a lot more private than potentially an apartment. That's what I mean. I would. That's what I would probably look at. Is I would say, okay, do I like what I'm living? If someone gave me $1 billion, if I won a bunch of money, maybe I'd move, maybe I wouldn't. I'm already in a house, so but that would be something I would ponder, and I would ponder, living in the the spot that I'm in. I would say, well, is this where I really want to live? You start asking all those questions. Bank of Japan, sorry to wake you up, but this is the opposite flipped over. This is the USD JPY. You can see the breakout when I flip it over going upwards. JC had it the other way and was showing the bond prices. So yes, this looks like a breakout, and it looks like the dollar is ready to rip. That's what it looks like, at least against the yen. Art Berman says February world liquids output increased by zero point 0.2 million barrels per day, higher than 2018 peak, but it was down minus zero point 0.8 million barrels per day less than the December 2023 peak. Production is about 4 million barrels per day more than the 5-year average. So here's the 5-year average in there, and then you can see how our production, it does look like it's rolling over. But again, we'll see. We'll see what occurs, and we'll continue to monitor the data in world's liquid production. Cuppy says she's getting desperate. Anyone who buys a treasury gets a free COVID booster. Hey guys, there you go. Biden calls on companies to use record profits to cut prices. Biden, inflation down more than 60% from peak, but more needed. What? What is this guy smoking? First off, record profits, I mean, that's the whole point of the game for a lot of these for profit companies. Number two, inflation is not down more than 60%. The rate of inflation might be declining, but that still means that you are going up in inflation. So I don't know if he understands the difference. I don't know if he really said that or not, but I read this and it doesn't make any sense to me. That's what I read. I don't know why he'd even ask this. This guy is he is so desperate to try to get reelected. It is unbelievable how desperate this guy looks. He looks very bad. Uh-oh, now that is ugly, bigly ugly. So the US CPI Supercore is up 8.2% over the past 3 months annualized. Look at this. Look at this move here, guys. US CPI Supercore. Ripping higher here. Rick Rule says we need to replace the biggest copper mine in the U.S., the Bingham Canyon, every year for the next 10 years to meet current demand, assuming demand doesn't grow, which it will. Good luck with that. Copper's going higher. We need to price out some demand to make it equal with the supply that we do have. March CPI, core CPI is greater than 0.36% month over month. The big driver of the hotter than expected number is once again motor vehicle insurance. Car insurance plus shelter equals 70% of core service inflation. Goods deflation returned minus 0.04% month over month is what we've got for the numbers. Now, here's the thing that I question. Do we even think these numbers are correct? A lot of the numbers I think are kind of doctored up. So, yes, it's probably a stronger number, but these are like doctored up numbers too. I can't imagine what the real rate of inflation is over the past few years. Shanghai silver versus COMEX silver, $30, well, about $31 in China. And we're just a skosh over 28 bucks. The the physical drain continues, is what I'll say, from west to east. Tom Engel has lived off his portfolio for 40 years. How? He's an incredible investor with a brilliant cash management strategy. Here's exactly how it works step by step. You build cash when things are overvalued, and you buy the bargains when they're undervalued. And this is your protected value going up. Wow, that looks pretty easy there. So let's say Tom's portfolio is worth $100,000 in the middle of a bull market. Tom is happy with this number and wants to protect it. He mentally calls this 100,000 his protected value. All his cash management decisions are based on this number. So Tom always has a feel for the market. Is undervalued, fairly valued, overvalued? Tom keeps 12% of his protected value in cash in a fairly valued market. That's 12,000 bucks. So let's say the bull market continues, Tom's portfolio continues to grow. He trims some of his holdings as valuations expand and his net worth grows. If valuations continue to expand, Tom can't find any stocks trading at bargain prices. He concludes the market is overvalued, and then he says that basically if it's a $130,000 valuation, he continues to trim and build cash, but he stops at 20% of the protected value. 20%. The bull market eventually stalls out, prices start to fall, Tom knows his bargains are beginning to appear. Tom continues to buy more as valuations improve. Tom is okay with his portfolio value falling hard, even below his protected value. If that happens, he knows he's buying tons of bargains. Let's say so what I do is I don't necessarily do and follow this method here. What I do is I always buy the undervalued bargain. And generally in the market, you get these 10-year, this is 10 years in length here from bottom to top, 10 years. So you buy an undervalued asset, you ride it on up, you sell this asset and buy the one that's out of phase or cycle. Commodities move like this. Commodities go like this out of phase versus the stock market. So when the stock market goes down or sideways, that's generally when commodities go up. So you can cycle between commodities going up and then the stock market falling, and then you sell at the peak, let it all crash together, buy stocks at the bottom here, and then ride stocks up while commodities stay depressed. That's how I play the market. And the bargains are always there with out of cycle phase investments. So US CPI data is out today. Gold likes it when CPI underperforms the producer price index. And that's where, well, basically, PPI is the leader of CPI. So when the producer price index outpaces the CPI, it means you're in an inflationary environment. That's when this pulls back down. So your PPI, which is your producer price index, is going up at a faster pace than your consumer price index. It's the leading indicator that you have inflation. And this is the leading indicator. So Z is the president of China, says doesn't want the peasants to keep front running him. The Shanghai Futures Exchange has imposed transaction limits on gold and copper positions, futures, to control recent trading price spikes. The daily opening position limit has been set to 2,800 lots for gold and 2,000 lots for copper. Probably nothing. Peter Schiff says commodity prices are soaring because the Fed's QE programs created so much inflation. Interest rates are still too low, credit is still too cheap and plentiful, enabling governments and households to borrow too much to spend on consumption without sufficient goods production. Correct. Inflation is more or less the relationship of credit expansion in relationship to GDP. Silver, look at silver, resistance ahead, pullback, buying opportunities, 25.50 to 26 is his humble opinion. And we're right up against that resistance of about $28, $29. We're trying to break through it. And we're right up against it for silver. This is platinum. This chart is so explosive and similar to silver. Everyone is sleeping on this metal for platinum. I'm not sleeping on it. I love platinum, and I do think we'll break out here shortly. Very, very soon, guys. It's coming. SRS Rocker report says gold is says we disagree. Gold is an inflation hedge because the price is predominantly based on the cost of production, which has increased from 375 in 2004 to over 1,700 currently. Thus, its safe haven aspect is based on the cost of removing it from the ground. Agreed, that's what makes it limited. You can see the gold price versus the Barrick and Newmont costs continuing to rapidly move higher over time. And look how low their costs were in 2000. Wow, big difference there. Here's Grady. It says many are worried about that the miners are not outperforming metals yet, but it is not unusual for metals to take the lead up from big lows. And when the wall of worry really lets go, we will see 8 to 10% up days for GDX and 10 to 15% up days for SILJ. A true generational opportunity is a this commodities bull market is going to be the ride of our lives. So he's got GDX versus GLD, 16-year chart, large PM miners versus gold, ready. We have a breakout retest, and we're ready to rip here, guys. Here's GDX. Breakout is incoming any second now. Get ready to ride this bull market, boys. Get ready. And here is Patrick Karam. He says, any guess what happened next to silver after gold broke out versus inflation? Big move is what occurs, guys. Very big moves here. So gold adjusted for inflation. You can see the big breakout for C here. And then you can see that we just broke out for silver, and it's ready to rip. So gold and silver are looking fantastic. Peter says, the hotter than expected rise in March CPI proves that interest rates are still too low. More rate hikes are required to move the rate back down to 2%. But not only will the Fed not deliver the required rate hikes, it's planning to reduce rates, fueling the inflation fire. Here's SLV breaking out. We're seeing all these breakouts, no matter how you draw it, looking fantastic. But that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Still have the LEAP coupon code, LEAP, that you can get a coupon or get a discount with. But overall, guys, everything looks pretty good. Everything with respect to commodities, precious metals, demand, supply, deficits, we're still good. Fundamentally, going up. All right, guys. We'll catch you later. This is Finding Value.